Welcome to another episode of Quest for Twice. Today is April 25th. The earnings season has started, so I'm going to cover earning updates from two companies in my portfolio. Before I do that, let me review the status of the stock market because this has been a very interesting year. Let's look at the chart on the bottom left. So the black bars are the stock price of the S&P technology sector, XLK. The line in the middle, less volatile, is an S&P 500 stock price performance in this year. The blue line is the S&P energy sector, and the line at the bottom, the orange line, is the S&P financial sector. So we can see the sector's performances start to diverge since beginning of February. Then in March, XLE and XLF sectors plummeted due to the banking crisis and the fears of bank runs. So that's really a reflection of the fear of a recession later in this year. In contrast, the XLK technology sector just kept going up. So now in April, the technology sector is hovering at a high plateau near the highest point in this year. We can also see both the energy and the financial sectors recovered somewhat in late March and April, reflecting a reduced fear of a recession. One can argue the technology sector was treated as a safe haven during the banking crisis, but the sector price is still staying up despite the recovery of the financial and the energy sectors. So is the market price rational? Let's look at my favorite valuation metric, that is price over sales ratio. So at the bottom right, we see the S&P 500 technology sector price over sales since 1993. There was a very high peak around year 2000. That's the well-known technology bubble. So outside that bubble, usually the price over sales ratio stays between 2 and 3. And it had a run up before the pandemic to reach over 4. Afterwards, it really took off, reached almost 8 before a significant drop in last year. In this year, it had a sizable rebound. So the current price over sales ratio is not seen outside the year 2000 the technology bubble as well as the bubble post-pandemic. That reflects a very strong optimism from future rate cuts. So the investors implicitly believe a very high profit margin, so that for the same amount of sales, more profit will be generated to justify the high price over sales ratio. That appears to me to be overly optimistic, especially if inflation stays sticky. Then the long-term stable interest rate will be higher before the pandemic. And the current price over sales ratio looks really overvalued. Now let's move on to look at the earnings from Kinder Morgan. So Kinder Morgan had a boring first quarter, which is a good thing for a pipeline company. The 2023 EBITDA now is forecasted to be about $7.7 billion, higher than last year. However, if we move over to DCF, we see the guided full year DCF is about $4.8 billion. That's less than $5 billion delivered last year. The explanations are including higher interest rate payment. We can see in the last column, the interest is forecasted to be about $300 million higher in this year due to the rising interest rate environment. Also, the management guided that the sustainable capital will be higher in this year. As a result, there will be less money flowing into the DCF, distributable cash flow. However, the 4.8 billion DCF is still plenty to cover anticipated capital of 2.1 billion and forward dividend of 2.55 billion. So as a matter of fact, Kinder Morgan spent about $113 million in the first quarter for share buyback. So based on the EV over EBITDA ratio of 9.2, based on the current stock price, I think the Kinder Morgan stock is fairly valued. Equifax also provided the first quarter earning update. First of all, its management reaffirmed its full year revenue guidance. So there is no update to the revenue trend is shown at the top right. The mortgage headwind continued in 2023. As a reminder, in 2022, there were 56% fewer mortgage originations compared to 2021. So that trend continued. The mortgage revenue was down 33% in first quarter of this year. However, its core business is still doing well with a core growth of 10% on constant currency basis. As a result, the total revenue in the first quarter was down by 4% only. As in the past, its EWS segment was driving the growth. In the first quarter, its EBITDA margin was 29.2%. With the adjustment, it was 31%. That's less than the adjusted margin of 33.6% last year. It's because of the margin impact from mortgage market headwind, as well as special charges related to stock compensation. However, the management gave an upbeat guidance in terms of margin, with a gradually rising margin in this year and reaching 36% in the fourth quarter of this year. Part of that rise is because of the 120 OPEX expense reduction. The management also guided about $80 million capex reduction to improve the free cash flow. Now let's look at the long-term growth drivers. Its cloud transformation is still ongoing and will wrap up for North America in this year. The new products and the innovation rollouts are still strong. In the first quarter, its vitality index was 13%, same as the full year guidance. Its workforce solution is also going strong, partly driven by just a continued growth in the number of contributors as well as of number of records in its database. So there is no reason to doubt the long-term growth guidance given by the management by line of business. That's shown at the bottom right. There was no new M&A announcement in the first quarter. As a reminder, Equifax will acquire BVS in Brazil in the third quarter of this year with about $160 million run rate revenue. So that growth engine is still humming. Let's look at the investment thesis. There is no real update. At about $200 per share, its enterprise value is about 30.4 billion, with EBITDA about 1.8 billion forecasted in this year. The EV over EBITDA ratio is about 16.9. So I consider as a good company fairly priced. Now let's look at the short-term risk from the mortgage market. You can see from the chart at the top right. In the first quarter, the mortgage increase dropped by about 42%. The management guided about 33% drop in the second quarter. However, the anticipated number of increase would only drop by about 13% in the second half of this year, because the mortgage revenue was only about a quarter of 2022 Equifax revenue. Then most likely in third quarter or fourth quarter, Equifax revenue will return to growth on a year-on-year basis. Another risk is impending recession. Equifax modeled a recession in the second half of this year. However, as the information provided before by the management, about half of its business is recession resilient. So I see no real change to my investment thesis given before. That is to buy a high quality growth company at a reasonable price. Because I think the current stock market is richly priced. So there probably will be better entry point later in this year. So when that happens, I may build to my Equifax position. This concludes this episode of Quest for Twice. Until next time, happy investing.